I want you to think about something for a second. XRP ETFs have pulled in $1.4 billion in institutional inflows since November 2025. 1.4 billion. And yet, XRP's price is down 43% in 2026. How is that possible? How does an asset attract over $1 billion in fresh institutional capital and go down? Most people can't answer that question, and that's exactly the point, because the answer lives inside a single SEC filing that almost nobody in retail has actually read. And when you understand what's in that filing, specifically what Goldman Sachs has been doing, you will understand not just where XRP has been, you'll understand exactly where it's going. Let's get into it. Every quarter, institutional investment managers with over 100 million in assets are required to file a document with the SEC called a 13F. It's a mandatory disclosure, a public scoreboard, and most retail investors have never looked at one in their life. But I did, and buried inside the most recent 13F filings, filed by the largest financial institutions on earth, I found something that stopped me cold. Goldman Sachs, not a crypto hedge fund, not a tech billionaire, not a DeFi protocol, Goldman Sachs is the single largest institutional holder of XRP ETFs in the United States. Their position? Just under $154 million across 4 separate XRP ETF products. Here's what makes that number staggering. The next 29 largest institutional holders of XRP ETFs combined hold less than Goldman's position alone. Goldman Sachs accounts for over 70% of the total XRP ETF holdings among the top 30 institutional investors in America. 70%. One institution, the most powerful investment bank on earth, holding 70% of the institutional XRP ETF market. Now, stay with me, because the question isn't just what Goldman holds. The question is why. And the answer to that question reveals a level of institutional conviction that retail investors are completely unprepared for. I want to make sure you understand the full weight of what this means, because Goldman Sachs is not a speculative investor. Goldman Sachs does not make $154 million bets on a hunch. Goldman Sachs does not move first unless they already know what comes next. Let me give you some context. Goldman manages roughly $3 trillion in assets. They have been around since 1869. Their alumni run central banks, treasury departments, and regulatory agencies across the globe. When Goldman moves, it is because their research teams that most retail investors will never have access to, have already modeled the outcome. Here's their history in new asset classes. When Goldman entered the gold ETF space in the early 2000s, gold was considered a fringe investment. 3 years after their institutional positioning became visible, gold had tripled. When Goldman began building equity ETF infrastructure in the 1990s, index funds were a niche product. Today, they are the dominant investment vehicle on earth. Goldman does not speculate. Goldman positions. And right now, today, Goldman has positioned $154 million into a single digital asset. Not Bitcoin, not Ethereum, XRP. That is not an accident. That is not a mistake. That is a deliberate, high conviction, institution-wide decision made by the most sophisticated financial machine in human history. The question you should be asking right now is not whether Goldman knows something you don't. The question is, what do they know? Let's look at the structure of Goldman's position more carefully, because this is where it gets really interesting. Goldman didn't just buy one XRP ETF product. They spread their position across 4 different XRP ETF products. That tells you something critical about their intent. When an institution concentrates a position in a single product, it's often tactical. It's a trade, in and out. When an institution distributes a position across 4 separate products with different fee structures, different custodians, different distribution networks, that is infrastructure building. That is long-term strategic positioning. Goldman isn't trading XRP. Goldman is building XRP exposure into their institutional architecture. And there's a second layer to this. Goldman Sachs operates one of the largest wealth management platforms on earth. They manage money for sovereign wealth funds, pension funds, endowments, family offices, and ultra-high net worth individuals. The XRP ETF position in their 13F filing, that is almost certainly not Goldman's own proprietary capital. That is client capital. Goldman's wealth management clients, the largest pools of institutional money in the world, are being directed into XRP ETF exposure through Goldman's platform. Think about what that means for demand. Goldman's clients don't make small bets. I want to pause here for a second, because what I'm about to show you in the next section, why Goldman's buying hasn't moved the price yet, and what happens when it does, this is the part that most analysts miss completely. Make sure you're subscribed and the bell is on, because the follow-up to this video is going to go even deeper into the institutional demand mechanics that are building right now. You don't want to miss it. Now here's the question I know you're already asking. If Goldman Sachs is holding $154 million in XRP ETFs, if institutional inflows into XRP ETFs have hit $1.4 billion, why is XRP's price down 43% in 2026? This is the most important question in crypto right now. And the answer is not complicated, it's just hidden. Goldman Sachs is not buying XRP on the open market. They are buying XRP ETF shares, which represent XRP exposure, but which are created, custodied, and managed by the ETF issuer, not by Goldman directly. Here's how it works. When an institution like Goldman buys shares in a spot XRP ETF, the ETF issuer is responsible for holding the underlying XRP. The ETF issuer goes to the market, typically through authorized participants and OTC desks, and acquires XRP at current prices. But here's the key. OTC acquisitions of this scale are intentionally designed not to move the spot market price. They happen off exchange, through dark pools, through bilateral agreements between large counterparties. The buying is real, the inflows are real, but the price mechanism is being deliberately managed. This is not manipulation. This is how institutional accumulation works at scale. If Goldman tried to buy $154 million in XRP directly on Binance or Coinbase, the price would spike instantly. Liquidity would drain. Retail would front-run them. Goldman would pay a massive premium. So instead, they use the ETF structure as a wrapper. The ETF issuer accumulates the underlying XRP quietly, off-market, over time. The result? $1.4 billion in institutional inflows, and a price that retail investors read as bearish. This is not a weakness. This is the setup. Because here's what happens when accumulation ends and distribution begins. I want to show you a pattern, because this has happened before. Cast your mind back to early 2023. Bitcoin spot ETFs had not yet been approved in the United States, but institutional players, Goldman, BlackRock, Fidelity, were already building exposure through futures products, offshore vehicles, and OTC agreements. Bitcoin was trading sideways, some months down. Retail was frustrated. The narrative was, institutions don't care. Crypto is dead. Then January 2024 happened. The spot Bitcoin ETF approvals hit. And in the 12 months that followed, Bitcoin went from roughly $40,000 to over $100,000. But here's what most retail investors still don't understand about that move. The price didn't go up because the ETF was approved. The price went up because institutional accumulation, the quiet, off-market, OTC accumulation that had been happening for 18 months was complete. And when it was complete, the bid came off. The supply that had been quietly absorbed was no longer available at those prices. That's when retail entered, at 60K, at 80K, at 100K. The institutions that accumulated at 25K and 30K and 35K, they made 3X, 4X, 5X. Now look at XRP. 7-spot XRP ETFs approved. 1.4 billion in inflows. Goldman Sachs positioned as the dominant institutional holder. Price down 43%. Tell me, does that pattern feel familiar? The accumulation phase is not over yet, but the fact that Goldman has already disclosed a $154 million position in a public SEC filing tells you something critical. They're not hiding anymore. When institutions stop hiding, it's because the accumulation is nearly complete. Let me tell you what I think Goldman Sachs knows that retail investors don't. First, the Clarity Act. The Clarity Act creates a legal framework for digital assets to be used in institutional payment infrastructure. XRP, as a declared commodity under the Clean 16 ruling, is now legally cleared for use as a settlement layer in institutional payment rails. Goldman Sachs processes trillions in client transactions annually. If XRP becomes the settlement infrastructure for even a fraction of those flows, as a utility asset, not just an investment, the demand equation changes permanently. Goldman isn't just investing in XRP. Goldman may be positioning to use XRP operationally. Second, the ETF approval pipeline. Of the 7 spot XRP ETF applications currently before the SEC, several remain pending full approval for broad retail distribution. When those approvals come, and given the current regulatory environment under the Clarity Act framework, they will come, retail access to XRP through brokerage accounts expands dramatically. Goldman's wealth management clients will be able to access XRP ETF exposure through standard brokerage accounts, retirement accounts, and institutional portfolios. The demand pipeline that opens when that happens dwarfs the $1.4 billion we've seen so far. Goldman knows the pipeline is coming. That's why they positioned first. Third, the global picture. The same 13F data analysis shows that European institutions account for a significant share of global XRP ETF demand. The US institutional market is the last major market to fully open. Goldman is not just building a domestic position. They are building the infrastructure to distribute XRP exposure globally across their entire client network. The 154 million you see in the 13F filing, that is the seed position, not the full play. Here's how I see the sequence playing out. And I want to be clear, this is analysis, not financial advice, but the mechanics are real and the data supports the direction. Stage 1, OTC accumulation continues. ETF inflows keep building, price stays suppressed, retail stays confused. Stage 2, remaining XRP ETF applications receive full SEC approval. Retail brokerage distribution channels open. Goldman's wealth management platform begins offering XRP ETF products to retail clients through their standard advisory services. Stage 3, the bid comes off the OTC desks. Institutional accumulation is complete. Available supply at current prices disappears. Stage 4, retail demand floods in through the newly opened ETF distribution channels. The same channels Goldman just finished building. That is the sequence. And Goldman Sachs, the most sophisticated financial institution on earth, is already at stage 1 and moving into stage 2. Retail investors will hear about this at stage 3. The ones watching this channel are hearing about it now. Let me bring this home. Goldman Sachs does not make $154 million mistakes. Goldman Sachs does not build 4-product XRP ETF positions across their institutional platform on a whim. Goldman Sachs does not quietly absorb 70% of the institutional XRP ETF market by accident. They saw something that their research teams, their regulatory intelligence networks, their payment infrastructure analysts, and their capital markets divisions all agreed on. XRP is not a speculative bet. It is an institutional asset with regulatory clarity, payment utility, ETF infrastructure, and now the most powerful investment bank on earth positioned as its anchor holder. The window to understand this before retail does is closing. Goldman is already in. The question is, are you? If this gave you a new lens on what's actually happening in this market, drop a comment below. Tell me, does the Goldman position change your conviction? I read every single one. Like this video if the data landed. Subscribe if this is the level of analysis you want more of. I'll see you in the next one.